Hello, I'm Ali, and in this video we'll talk about audit evidence. Audit evidence is the information that an auditor gathers to support your opinion on the truth and fairness of the client's financial report. It is the responsibility of those charged with governance at a client to ensure that the financial report is prepared in accordance with Australian accounting standards and requirements of the Corporation Act 2001. They also need to ensure that accurate accounting records are maintained and any potential misstatements are prevented and detected and corrected in a timely manner. However, it is the auditor's responsibility to gather sufficient appropriate evidence to arrive at their opinion. What is sufficient and appropriate evidence? Sufficiency relates to the quantity and appropriateness relates to the quality of audit evidence gathered. Both concepts are interrelated as the quality of evidence will affect the quantity required. When detection risk is set as low, high quality evidence is gathered by the auditor. Audit risk affects both quantity and quality of evidence gathered by the auditor during the risk response phase of the audit. This figure demonstrates the relationship between audit risk and quality of audit evidence required for the client. In a situation where there is a significant inherent risk that an account will be misstated and the client system of internal controls is not effective at reducing the risk of material misstatement, detection risk is set as low and more high quality evidence is gathered when conducting substantive tests of that account. In contrast, when there is a low inherent risk that an account will be misstated and the client system of internal controls is considered to be adequate for that account, detection risk is set as high and less quality evidence is gathered when conducting substantive tests of that account. The appropriateness or quality of evidence is affected by its source or from where it is gathered. For example, externally generated evidence is considered more reliable than evidence produced by the client. The appropriateness or quality of evidence is also affected by the audit assertions at risk. Evidence is considered to be more appropriate if it provides confirmation about an assertion most at risk of material misstatement. For example, if an auditor determines that the primary assertion at risk is the existence of inventory, it would not be appropriate to spend more time gathering evidence in relation to the completeness assertion than the existence assertion. In this section, we'll be looking at various types of audit evidence which an auditor normally collects before expressing an opinion on the entity's financial report. The first type of audit evidence is external confirmation. ASA 505 provides guidance on the use of confirmations that are generally considered to have a high degree of reliability. External confirmation is a letter sent directly by an auditor to a third party who is asked to respond to the auditor on the matter included in the letter. External confirmation can be sent to the client's bank, lawyers, lenders, debtors, and even to the third parties holding the client's inventory. A bank confirmation letter is a request for information about the amounts of cash held in the bank or in overdraft, details of any loans with the bank, details of any pledges of assets made to guarantee loans and interest rates charged. This information is used to confirm by the bank reconciliation that the cash at bank is recorded at the appropriate amount, is in the client's name, and that all loans with the bank are included in the liability section of the balance sheet. An external confirmation letter may be sent to a client's lawyer if the lawyer holds documents on behalf of the client that are of relevance to the audit. A client's lawyer may also hold property title deeds, patents, and other documents that provide audit evidence. If a client's lawyer holds title deeds to property owned by the client, the auditor will send a confirmation letter requesting that the lawyer confirms that the title is in the client's name. This will verify rights and obligations assertion. While rare, an external confirmation may be sent to clients' sub-lawyer or lenders to confirm the details of amounts owed to creditors and significant loans. Payable confirmations can only be used if the auditor is certain that the list of lenders supplied by their client is complete, as it does not provide evidence regarding the completeness assertion. External confirmation can be sent to debtors to verify their receivables balance. The auditor will select the debtors to whom they will send confirmation. Auditor uses some criteria when selecting the debtors to be sent confirmation. The criteria generally include materiality such as large trade receivables, age or overdue amounts, or location. The primary assertion when using receivable confirmations is existence. They provide audit evidence that debtors exist. They also provide some evidence on ownership, which is right and obligations, as debtors confirm that they owe money to the client. As debtors are asked to confirm that they owe the amount outstanding at year end, very little evidence is provided regarding the accuracy, valuation, and allocation assertions. Debtor only confirm the amount owing. They do not confirm their intention to pay the amount due. External confirmation may be used when a client owns inventory that is held on its behalf in another location. That is, the inventory is held in premises not owned by the client. In this case, the auditor may send a confirmation asking the third-party owner of the premises where the inventory is held to verify the description and quantity of inventory held. This type of confirmation provides audit evidence that the inventory recorded by the client exists, is complete, and is owned by the client. There are two broad types of external confirmation: positive and negative confirmations. Negative confirmations asks the recipient to reply only if they disagree with the information provided. If a recipient does not respond to a negative confirmation, it is assumed that they agree with the information provided. This form of request is of limited benefit when the assertion being tested is existence. A negative confirmation may be used when the auditor has conducted detailed testing for existing using alternate procedures such as citing signed delivery dockets. In this case, the negative confirmation is used to corroborate other evidence. Positive confirmation asks the recipient to reply in all circumstances. Thus, they provide superior evidence as a non-response from a non-response from a negative confirmation request may provide false assurance. For example, a client may record fake sales to ghost customers who do not exist close to year-end to boost revenue. A non-response from a non-existent or ghost customer may be interpreted by an auditor as confirmation that the customer agrees with the amount outstanding. In this case, the conclusion would be unjustified. Overall, it's normal practice for the auditor to obtain confirmation evidence for accounts receivable whenever it's practical and reasonable, and to do so, and it is a standard practice to obtain confirmation for bank balances. The use of confirmations in other applications depends on the relative cost and reliability of alternative forms of evidence that may be available to the auditor. Nevertheless, the effect involved in preparing and sending confirmation requests and in analyzing the responses can be quite time consuming, which is often making this a costly form of evidence. Documentary evidence includes invoices, suppliers' statements, bank statements, minutes of meetings, correspondence, and legal agreements. Documentary evidence, which may be generated internally or externally, are usually contained in entities' files and are available for the auditor's inspection on request. ASA 502 requires the auditor to gather sufficient appropriate audit evidence regarding any legal matter involving their client. Evidence is gathered from board meeting minutes, discussions with client personnel, and representation letters from their client's lawyers. When an auditor has reasons to believe that legal issues exist which may impact the financial report, such as a client being sued by a third party, or when a legal firm is engaged by the client for the first time, a representation letter is requested from the legal firm or firms that their client deals with. A legal representation letter is generally sent to the client sent by the client to its lawyers, asking them to complete the representation letter and send it directly to the auditor. A legal representation letter can include any legal matters involving the client, the lawyer's opinion on the client's description of any outstanding legal matters, and whether the client's evaluation of those matters appear reasonable. You may refer to a figure in the textbook, which is on the first slide, and that is an example of legal representation letter in chapter 5, figure 5. You may also refer to an appendix 1 of ASA 502 for an example of a request for a representation letter from a client to their lawyer. ASA 580 requires that an auditor should obtain written representation from their client's management. A management letter includes an acknowledgement of the management responsible for the preparation of the financial report. Management is responsible for ensuring that the report is prepared in accordance with the Corporation Act, giving a true and fair view of the company's financial position and complying with Australian accounting standards. The letter will include written details of any verbal representations made by the management during the course of the audit. A verbal evidence is weaker than a written evidence. The auditor will seek written confirmation of any significant discussions in the management representation letter. The management letter can also include an undertaking that laws and regulations have been complied with, and that there have been no material frauds or errors that impact the financial report, and that the internal control systems are effective. The letter can acknowledge that the auditor was provided with access to all documents, records, and other evidence as requested. It is recommended that auditor should not completely rely on management representation letter. The auditor should confirm management version with other corroborating evidence. Appendix 2 of ASA 580 contains an example of a management representation letter. Throughout the audit, the auditor will make frequent oral inquiries of officers and key employees. Oral or verbal evidence is rarely reliable by itself. Its main value lies in directing the auditor to other sources of evidence, corroborating other types of evidence, and disclosing matters that may benefit further investigation and documentations. Nevertheless, the verbal evidence is very commonly used when gaining an understanding of the client and its system of internal controls. When oral evidence plays a key role in an audit decision, The source, nature, and date of the evidence should be documented in the working papers. When obtained from management, the auditor may ask that such evidence be reaffirmed in writing in the management representation letter. Computational evidence is gathered when an auditor checks the mathematical accuracy of the numbers that appear in the financial report. This involves re-adding the entries included in a client's journal and ledgers. It also involves recomputing more complex calculations such as foreign currency translation, FBT or fringe benefit tax, interest of loans outstanding, and fair value modeling. When conducting complex recomputations, the auditor agrees the amounts included in the calculation to externally prepared documentary evidence when available or where available, as well as checking that the formulas used are applied appropriately. Physical evidence is gathered through inspection of a client's tangible assets such as its inventory and fixed assets. The auditor traces details of tangible assets on hand back to the recorded amount. For example, the auditor selects physical inventory items, counts the numbers on hand, and traces them back to client records to make sure that their records are complete. This test is done to ascertain whether quantities on hand are accurately included in the client's records. The auditor inspects a client's physical assets to ascertain whether machinery is functioning, inventory is in good condition, and fixed assets are well looked after. This evidence is used to determine whether assets should be written down below current book value. If inventory appears dusty, perhaps the client is having difficulty selling those goods. If machinery is not being used, perhaps it's obsolete or redundant. If the auditor does not have the expertise to ascertain the value of client's assets, they may ask an independent expert for some help. Electronic means the use of computers, scanners, magnetic media, and other electronic devices associated with the creation, manipulation, transmission, and reception of electronic data. Electronic evidence is any information used by the auditor that is produced or maintained by electronic means, and it includes data held on a client's computer files, sent via email to the auditor, and items scanned and faxed. Normally, transactions are initiated and stored electronically. They leave no paper trail. To get the details of these transactions, an auditor must access their client's computer system where details are kept. It is now common for companies to send their auditors copies of their accounting records and files via email. The auditor then searches for corroborating evidence to verify the amounts included in the files. The extent to which an auditor can rely on electronic evidence produced by their client's computer system will depend on a great deal on the internal controls in place. As discussed in earlier recordings, IT creates risks within a client's accounting system. The auditor must consider those unique risks and assess the effectiveness of their client's internal controls in mitigating those risks. The auditor uses data analytical softwares to assist with gathering and analyzing evidence. This allows for the use of electronic spreadsheets and paperless audits, as well as more sophisticated procedures. The auditor uses software to perform procedures such as calculations, comparing current year with prior year amounts, and to select samples for testing. Data analysis involves the use of software to discover and analyze patterns, identify anomalies, and extract other useful information from client data. The auditor then draws conclusions and communicate the information. The auditor may use data analytics to produce graphs, charts, trend lines, scatter diagrams, and dashboards. Traditional audit techniques compare aggregate figures such as current year sales compared to prior year sales, while data analytics allows for an auditor to conduct a deeper examination of sales activity. For example, summarizing every sales transaction for the year into a graph. This deeper analysis shows more detailed trends with highs and lows of sales activities. Knowing more about their client helps auditors to plan a more effective audit. Using data analytics makes the audit more comprehensive, as well as a client data can be accessed and analyzed, and more efficient as the software can handle large volumes of data. Data analytics can be used during the risk assessment and risk response phase of the audit. The main consideration is in deciding whether to use data analytics are the completeness of the client's records and the reliability of client's data. As with any audit procedures, the nature and extent of the procedures performed with data analytics will largely depend on the evaluation of the effectiveness of the client's information technology controls. And that's the end of this recording. In the next video, we will talk about tracing and vouching. Thank you.